Holding company. The following information is not related to any business or legal firm, it's purely for educational purpose. Next we will talk about a holding company. A holding company is one that individuals form for the purpose of purchasing and owning shares in other companies. By holding stock, the parent company gains the right to influence and control business decisions. The purpose of holding company is to allow those who own several businesses a way to limit liability, create a streamlined management, and maintain ownership over each business. A holding company provides a central point of control over the businesses. Companies will often set up a holding company to gain tax efficiencies, minimize risk, or prepare for sale or succession. There are clear benefits to creating a holding company, as it can be used to protect profits or to separate out assets such as a business premises from the main trading company. Holding companies protect the parent company from losses by subsidiaries. Holding companies can provide cheaper operating capital to their subsidiaries. Parent companies can take advantage of regional taxation laws by moving the holding company and subsidiaries to different jurisdictions. If you're managing multiple businesses or looking to invest in several cash-generating businesses, it might make sense to consider starting a holding company. The holding company can provide protection for your business assets along with potential tax benefits. Holding companies can offer a number of advantages, including the ability to operate your business and ensure that your family receives the income from your business. However, holding companies also have a number of disadvantages, including limited liability protection and high costs. One of the most important exceptions is if the corporate veil is pierced, meaning that the action was outside the normal activities of a business. In this case, the owners of both the subsidiary and the holding company could be sued. Rules of a holding company indicate that a bank holding company must control, own, or have voting power over at least 25% of a financial institution. Control the election of a majority of directors on the company's board. Possess a controlling influence over the organization's policies. Anyone can form a holding company to control their business assets. However, those who own multiple businesses will often find this structure even more beneficial than those with a single venture. This is because multiple businesses increase the potential for liability and losses. In most cases, the parent company stays in control by being the only shareholder or by creating subsidiary bylaws. Since the two companies are separate, each pays its own taxes on its own income. A holding company pays its owners by dividends from subsidiaries. As the major shareholder, a holding company will receive dividends from the subsidiary companies it owns. In some cases, they may regularly take excess capital from subsidiaries. The management penetration risk faced by holding companies refers to the fact that, due to the unclear boundaries of rights and obligations between the parent company and the subordinate enterprise, an internal control system management and an internal decision-making mechanism. The typical holding company structure involves creating a parent company at the top to hold all the subsidiaries' assets. The corporation or limited liability company holding company structure will then include multiple subsidiary businesses. Yes, one person can form and own a holding company. But if you're a small business owner in charge of several companies, for example, if you own 3 stores across town, each one its own limited liability company, a holding company helps to minimize risk and shield against cascading losses. Unless the holding company is included in a VAT group, it will need to have taxable business activities, or at least an intention to make taxable supplies. In order to be entitled to register, VAT companies will often set up a holding company to gain tax efficiencies, minimize risk, or prepare for sale or succession. There are clear benefits to creating a holding company, as it can be used to protect profits or to separate out assets such as a business premises from the main trading company. The most widely used entities for holding companies usually are limited liability companies and corporations. Whether to use a limited liability company or a corporation, it depends on many factors. Your solicitor must weigh the pros and cons, especially as it relates to complexity, asset protection, and tax. Holding companies also make money from buying and selling assets. As majority share owners of their subsidiaries, significant profits can be made when those companies perform well. Holding your investments inside a corporation will not necessarily allow you to write off additional expenses. The only expenses that are deductible by a corporation are those expenses incurred in order to produce income. The main tax advantage of a holding company is that it does not have to file different tax returns for each subsidiary company. Generally, subsidiaries can pay dividends to the holding company without creating a tax liability. Holding companies need different bank accounts than their subsidiary companies. They are also required to maintain different accounting records. HMRC only requires one form because the holding corporation files a single tax return for the entire group. This consolidated tax return includes all earnings, losses, and profits for each subsidiary company, as well as for the holding company filing the return. To create your holding company, you register it in a state and provide your business name, articles of incorporation, and the name of the business agent managing the operating and holding company. If you so choose, one can be the agent for both the operating and holding company. A good reason for an overseas company decides to relocate to the UK is to take advantage of the UK company as a highly tax-efficient investment holding structure for the receipt of foreign dividends. When setting up a UK holding company, usually individual client requirements and circumstances will be considered before making a decision, but the following considerations will generally apply. The distribution exemption applies to dividends received by a UK holding company from a qualifying overseas company. The conditions are different depending on the size of the UK holding company, but typically there will need to be a double tax agreement, DTA, between the UK and the country in which the company paying the dividend is resident. If the exemption applies, then there will be no UK tax imposed on the dividend. UK holding companies can elect, under the foreign branch exemption, to treat all the profits and losses of trading by their overseas branches as being taxable in the relevant overseas jurisdiction only, rather than being taxable in the UK. The substantial shareholdings exemption rules also provides an exemption from capital gains for disposals of shares by companies that meet certain conditions. If a UK holding company owns a group of trading subsidiaries, at least two, and one of these is sold, the resulting capital gain arising should not be subject to UK tax. The UK does not impose withholding taxes on the distribution of dividends to non-resident shareholders, whether individuals or companies. The UK does not charge capital gains tax on the sale of shares in a holding company situated in the UK by non-residents. Therefore, if the holding company is itself disposed of by non-UK owners, either individuals or corporate, there is no exposure to UK capital gains tax. The one exception is if the UK company is property rich, then capital gains tax will likely apply. The combination of the UK's double tax agreement, DTA, network and attractive holding company regime, together with the good reputation of UK companies worldwide, represent compelling reasons for using the UK to establish an international headquarters. This can prove hugely beneficial when considering business expansion worldwide. I hope this information useful. Please like, share, and subscribe to receive more videos.